Hello everyone, my name is 𝗪𝘆 and I'm from the iFAST research team. While many people have been captivated by the S&P 500's stellar performance last year amidst concerns of a potential recession, there's actually another narrative in the global equity markets that demands our attention. And that is none other than Japan. A nation that has grappled with deflation for decades not only stood resilient, but also delivered impressive performance. It emerged as one of the top performing equity markets besides the US last year. And I'm happy to highlight that our research team did foresee this resurgence in Japanese equities. Back in late 2022, before the substantial rally witnessed last year, we had anticipated and also called for a turnaround. So to refresh your memories, the Japanese equity market, as gauged by the Nikkei 225 index, delivered returns of about 30% in local currency terms last year. And the last time the Nikkei 225 reached such a high price level of over 30,000 was actually about 3 decades ago, before a period known as Japan's lost decades. Now, the lost decades, they were challenging times marked by prolonged economic stagnation as well as deflation since the 1990s. However, we think gone are the days when Japan delivered underwhelming returns for investors. Today, the nation stands on the verge of structural changes that we believe will serve as the catalyst for the equity market to reclaim its lost decades of performance. And we think that this time is different for Japan. Now, you may be familiar with Warren Buffett, who is an iconic figure in the world of investing. Last year, his decision to increase investments into Japan's top 5 trading companies drew large attention to the Japanese equity market. So you may ask, what does Warren Buffett see in Japanese stocks? Well, we think it's because of an improving economic outlook as well as a more shareholder-friendly regime in Japan moving forward. Let me elaborate on this in my subsequent slides. So after enduring over decades of deflation, Japan is finally seeing some sustainable inflationary pressures. The Bank of Japan's preferred measures of inflation, they have consistently exceeded their targets for over 1 year now. If you look at the core CPI, which excludes fresh food prices, it currently stands at 2.5%. When we drill further down into the core CPI, which excludes fresh food and energy prices, it reveals a rate of about 4%. Now, to put this into perspective, that is an inflation rate that Japan hasn't seen since the 1990s. And before you say that we've been here before, it's really important to understand that past inflationary periods in Japan, which were short-lived, they were mainly being driven by the surge in oil and food prices, as well as the rise in consumption tax. But this time is slightly different. Inflation, for the most part, for the earlier part of last year, was actually being driven by the increase in import costs. And most recently, we are encouraged to see that the increase in price pressures in the country is driven more by the services sector. The services sector, it tends to reflect domestic wage trends, and we think it hints at the potential for broader price pressures in Japan. Now, we look at an important indicator with forecasting future wages, which is called the 𝗠tối. Now, that refers to annual wage negotiations between major corporations and unions that take place during spring. Last year saw major companies agreeing to average pay hikes north of 3%, marking the highest increase in 30 years. But the upward trend doesn't stop there. There are compelling indications of continued wage growth. Japan's largest labor organization, called Rengo, plans to request a total pay hike of about over 5% during this year's negotiations. And at the same time, UA Zensen, which is the largest industrial union, is targeting a 6% wage increment. And there are even more examples to show that wage growth in Japan is strengthening. And we think that the bottom line here is that with strengthening wage growth, Japan likely can get out of its decades-long battle with deflation. So what are the implications? Historically, falling prices in Japan, they provided an incentive to delay consumption and investments, which restrain economic growth. It's worth highlighting that cash holdings, they currently represent over 50% of household assets, as consumers have held on tightly to their savings over the years in response to deflation. At the same time, there are many Japanese companies which are flush with cash. We believe that in the longer term, the expectations of broader price pressures can encourage positive shifts in consumption and investments from consumers and businesses, which will help to spur growth. Inflation will also help to motivate domestic investors to explore riskier investments in order to protect their asset values, channeling inflows into the capital markets. And we think that such investment from households, they can potentially help to push Japanese stocks past their 1989 peak. So as mentioned, the lost decades had instilled a culture of heavy capital accumulation among corporations. We found that over 30% of non-financial companies in the Nikkei 225 index have net cash positions, which means that they have more cash than debt. And that is a percentage that is a lot higher compared to its peers in developed markets. For comparison, less than 20% of non-financial companies in the S&P 500 as well as Europe's Stoxx 600 have net cash positions. So this accumulation of cash on Japanese corporate balance sheets has often translated into low return on equity figures, especially when compared to their developed market peers, as well as price-to-book ratios that are below 1. But nevertheless, we see that change is on the horizon. The Tokyo Stock Exchange issued a mandate last year calling most listed companies, especially those who are trading below their book values, to account for their cost and efficiency of capital to their investors. And supported by robust earnings, today, there are more companies who are increasingly prioritizing shareholder returns through share buybacks as well as dividend hikes. And in this wave of transformation, dividends which are to be paid out by Japanese companies are expected to reach a new record high during the fiscal year 2024. At the same time, many large companies such as Mitsubishi Corporation, which is one of the companies that Warren Buffett has invested in, is stepping into the spotlight with their share buyback plans. And in view, the Tokyo Stock Exchange call for companies to disclose long-term plans to improve their capital efficiency represents a pivotal step in the right direction. And we note that beyond share buybacks and dividend hikes, companies do possess a range of options to enhance their capital efficiency. And that includes increasing investments into research and development, investing into equipment and facilities, as well as restructuring their business portfolios. And such measures, they do hold the potential to boost long-term corporate earnings. And as a result, we are viewing such corporate governance reforms as a long-term tailwind for sustainable growth rather than a fleeting short-term catalyst. Now, another reason why we like Japan is due to its ongoing revival as a semiconductor powerhouse. We have just heard from my colleague 𝗪𝘃 earlier on. He was sharing about the immense long-term potential of the semiconductor industry driven by the rapid growth of AI. And do you know that Japan's chip makers, they once dominated the industry back in the 1980s, contributing to over 50% of global production? Now, recognizing the importance of regaining such a strong foothold in the global semiconductor market, Japan has launched initiatives aimed at fostering the growth of its very own semiconductor industry. And one major initiative involves a consortium composed of 8 major Japanese companies, including key players in the semiconductor industry, such as Sony and Kioxia. Together with the Japanese government, who has committed billions of yen, they have launched a semiconductor manufacturer called Rapidus. And this company, Rapidus, in partnership with IBM Research in the US, is working towards developing 2-nanometer technology by 2027, with plans for fabrication in Japan. And rather competing directly with global chip giants, this partnership aims to pioneer specialized chips. And a prime example will be AI chips with low power consumption. And this actually gains more significance amidst the ongoing geopolitical tensions between the US and China, especially over chips. The partnership between the US and Japan can potentially create a semiconductor supply chain that is less dependent on China. Also, Japan's technological prowess in semiconductors presents a competitive edge as global companies are now seeking to diversify their supply chains away from China. So for example, Japan has become a favored location for TSMC's overseas expansion. This will help to strengthen the nation's efforts to regain its lost status as a semiconductor powerhouse and also strengthen the country's semiconductor supply chain. And we do note that Japan's pivotal automotives and electronics industry, they do rely on a stable long-term supply of chips for growth. And over the long term, we also expect to see the export of semiconductors play an increasingly important role in driving growth. This will help to reduce the reliance on private consumption as a main driver of growth amidst an aging population. So supported by the catalysts that I've just mentioned, we do expect the Japanese equity market to reach new highs. The earnings outlook of corporations, they look promising on the back of stronger growth as well as corporate governance reforms. And furthermore, Japanese equities, they remain attractive from a valuation standpoint. The forward PE of the Nikkei 225 index currently stands at a 10% discount to the long-term average, even after the 30% price rally last year. And relative to its developed market peers, Japan also still trades at very attractive valuations. Now, we have projected a 2025 target price for the Nikkei 225 of 41,300. This price level is higher than what was seen during the peak back in 1989 and also translates into an upside potential of around 30% from today's price levels. But wait, that is not all for Japan. As you may know, everyone has been talking about how cheap the Japanese yen has become lately. The yen experienced a sharp sell-off against major currencies like the US dollar and also the Singapore dollar. Today, if you go down to the money changer, you can get about over 100 yen with 1 Sing dollar. But a few years ago, you could only get about 80 yen with 1 Sing dollar. So that's really how much the yen has fallen. And here's the news for you. We believe that the yen is currently at a turning point. In other words, yen will not continue to stay so cheap. What this means is that number one, if you have plans to go to Japan, you should change some yen as soon as possible. And number two, as investors, this means that you can stand to gain even more when investing in Japanese equities by opting for an unhedged exposure. So a key reason why the yen has fallen so much over the last 2 years can be attributed to the fact that the Bank of Japan has yet to give up on its ultra-loose monetary policy. But that said, we believe that the yield curve control, which is the YCC in short, which is designed to fight deflation by artificially keeping policy rates and bond yields at very low levels, is becoming increasingly unsustainable. So as mentioned earlier, we think that inflation in Japan is getting stickier. The Bank of Japan also shares a similar view, as it recently raised its forecast to project that inflation will well exceed its 2% target this year. We believe that Japanese officials will be paying close attention to this year's 𝗠𝗆𝘃𝗁 negotiations, where robust data would strengthen their confidence that the inflationary pressures in Japan, they are sustainable in the longer term. Japan has also signaled a gradual move towards ending the YCC, as late last year, the Bank of Japan governor acknowledged for the first time ever that the probability of achieving the long-term inflation target is rising gradually. And in our view, the Bank of Japan is aiming for an orderly exit from its ultra-easy monetary stance. What this means is that there's possibility of more policy tweaks in future meetings later this year to pave way for the potential abandonment of the YCC. And as such, we are seeing more room for Japanese government bond yields to adjust upwards. And with many other central banks now choosing to end their rate hikes and explore potential cuts, this divergence between the Bank of Japan and foreign central banks is likely to narrow yield differentials, and that would lead to an appreciation of the Japanese yen. So the yen is likely to increase in value against major currencies like the US dollar, the Sing dollar, the yen will also increase against the euro and the British pound, especially when considering the sluggish growth in Europe that really limits the capacity of the European Central Bank and the Bank of England to sustain their rate hikes. Beyond such major currencies, we are also expecting a very solid outperformance of the Japanese yen against the Chinese yuan in view of the domestic headwinds in China that may require more monetary easing. Our optimism is also underpinned by the fact that yen weakness has hit an extreme level. We look at the Japan real effective exchange rate, which represents the value of the yen against a basket of peers adjusted by consumer prices. And based on this, we can see that the yen is at an all-time low since data inception in 1970. And for us, we are expecting a solid turnaround for the yen to happen this year. What will truly be a game changer is the narrowing of yield differentials due to additional policy tweaks and a potential shift by the Bank of Japan in response to a new era of sustained inflation, while other central banks around the world, they are ending their rate hikes and exploring potential cuts. And we think that stronger yen is unlikely to hurt Japanese equities. Instead, it would enhance their attractiveness to foreign investors. It's worth highlighting that extreme weakness seen in a currency can be undesirable when it amplifies macro headwinds like trade deficits as well as import costs, then that will in turn could weigh on corporate earnings. So in summary, our investment case for Japan, we believe that it is well supported by several factors, and this includes the ongoing shift towards inflation in response to higher wage growth, corporate governance reforms, as well as the resurgence as a semiconductor powerhouse. And furthermore, the yen's rebound would lead to renewed interest from foreign investors. We think that all these factors combined can help to push Japanese stocks to new heights. So after enduring decades of underperformance, we believe that this time is different for Japan. And for investors who want to take part in this opportunity, we have two recommended products. One is the Eastspring Investments Japan Dynamic Fund, as well as the iShares MSCI Japan ETF, which is listed on the New York Stock Exchange under the ticker 𝗍𝗯𝘰. And in between these two in particular, we think that you should really check out the Eastspring Investments Japan Dynamic Fund, as we think that it is well positioned to benefit in the new era for Japanese equities. So this Eastspring Investments Japan Dynamic, it is a value-oriented fund which screens investment ideas which are attractive on an absolute and relative basis using criteria such as your PE ratio, PB ratio, dividend yield, long-term price performance, as well as the potential for earnings revisions. And in Japan's current environment of elevated inflation and higher bond yields, we think that value as a style should continue to perform well. For this fund, it currently has about 40 stocks, and due to its fundamental bottom-up stock selection, you may find that its top 10 holdings differ greatly from its benchmark, which is the MSCI Japan Index. The top 10 holdings, they mainly comprise of companies within the automotive space, like Honda and Nissan, as well as within the financial space, like SMFG, as well as Nomura. The investment team of the fund believes that automotive companies, they are now restructuring their business portfolios to become leaner and more profit-focused, which hasn't been priced in by the market. And meanwhile, for the financial sector, it is well positioned to benefit as the Bank of Japan gradually shifts away from years of ultra-loose monetary policy. And over a 5-year period, this fund has generally outperformed its peers as well as its benchmark. And this was especially helped by a substantial outperformance over the past year from Japanese value equities which are held by the fund. And we also note that this fund has a low turnover ratio, suggesting that the investment team has high conviction and believes in the potential for the underlying securities of the fund to do well over time. And with that, I hope that you have gained further insights into our views on the Japanese equity market as well as the Japanese yen. I've come to the end of my sharing for today. Thank you so much for your kind attention.